Welcome to the second annual Midwest Innovation and Entrepreneurship Summit, hosted by College of DuPage and Innovation DuPage. DuPage is home to Fortune 500 companies, 19 colleges and universities, 2 national labs, and a thriving entrepreneurial ecosystem. Whether you are a startup with an established firm, an educator teaching the entrepreneurial mindset, or someone dedicated to economic development, reach out to us. Let's connect to advance this work. Thanks for watching. The Midwest is a place where we get things done together. In 1963, anthropologist Margaret Mead was asked if instead of freeing the human spirit, if all of these engineering triumphs were simply dulling it. Sound familiar? She responded, automation is a method that removes the need for human beings to act like cogs in the machine. Certainly AI, in its rapid evolution, poses new threats and challenges, but it's also creating opportunities for us to focus on the more human aspects of work. She posited that intelligent machines in the future would allow us more time to think, to paint, to pray, to study, to philosophize, to observe, to take part in the universe. So I hope we'll invest this time we're saving in deeper collaboration between industry, higher ed, government, and entrepreneurs in shaping the future. Quick thank you to our primary sponsors who made today possible. There was a question about funding for research. Another part of the solution is we need participation from industry and corporations. And we have that today from Workday, Riverside Technologies, the Illinois EDC, Old National, and a host of others you'll find in our program. This next speaker represents a major investment firm with over $40 billion in global assets. Their founder is a veteran, he's an entrepreneur, and he is very active, as is his firm, in supporting everything local. John Adams is Senior Vice President and Chief Investment Officer at Calamos Wealth Management. He leads the firm's investment practice and multi-asset strategy, bringing 2 decades of market experience to help leaders navigate what's ahead. He's here to give us some insight on the future of the Midwest economy. Please join me in welcoming John Adams.
Welcome, everyone. Thank you for having me here today. It's an honor to be here with a distinguished group of entrepreneurs and small business owners. As Joe mentioned, our founder at Calamos, John Calamos, very much a supporter of education in particular. He's also very supportive of local businesses, local economy as well. So very, very, very honored to be here today. So I'll talk today about some exciting advantages that the Midwest has and that the U.S. has as well. We'll also talk about how AI fits into it. I was here for the previous panel as well. Can kind of follow on some of those remarks. But what kind of investment strategist would I be if I didn't start with a brief overview of the economy and the stock market? So I'll start out with a brief overview of how we're seeing the world right now at Calamos. There's been a lot of volatility over the last couple of months in markets and in the economy. A lot of uncertainty around trade policy, fiscal policy, monetary policy. Happy to touch on any of those in the Q&A. But if you look at the backdrop of the economy right now, the economy is pretty strong. We got some disappointing data for Q4 economic growth, GDP, last week, but overall the economy is pretty strong. But if you look at the underlying drivers of the economy, what's really driving that is higher income households are really driving a lot of that spending. So we have this, what we call a K-shaped economy where the upper leg of the K is doing very well. The lower leg of the K has been hit hard by inflation. The affordability is really the key word as we kind of head into the midterm elections, and we'll definitely talk about that today throughout the presentation. The job market has definitely slowed. We're adding quite a bit fewer jobs month over month than we were a year or two ago. That being said, the unemployment rate's still pretty low. It's in the low 4s right now, 4.3%, still pretty low historically, so not concerning. But again, we're not adding the number of jobs that we were a year or two ago from an economic perspective. On the positive side, we're getting some fiscal stimulus. You might already be seeing that at tax time in the form of refunds. We're seeing a lot of tax refunds as a result of the One Big Beautiful Bill for both consumers, individuals, as well as businesses. We also expect some more deregulation this year, which should be supportive at the margin, especially for those in the room, the business owners. Talking about the Fed, we always enjoy talking about the Fed and speculating there. I would say the main message here is the Fed's probably going to cut rates, at least once this year, maybe twice, depending on the data. But they're very much dependent on the economic data. They're worried about inflation that's still a bit above their 2% target, and they're looking at the employment market that's solid, but we are showing some signs of cracks there in the employment market. There's been a lot of political pressure on the Fed. I wouldn't expect that to go away anytime soon, especially in an election year. But the Fed will kind of largely tune out that noise. AI and equity markets, again, a big important consideration for us. I'm sure you've heard about the concentration with respect to U.S. stock indexes, that the top 10 companies make up about 40% of the overall stock index. So you've seen a lot of volatility in markets over the last couple of months. The only game in town's been large technology companies over the last 3 years or so. We've shown some signs of cracks there, year to date, especially, software, concerns about AI, eating software in general. We've seen kind of these waves of, moving from one industry to another, what's going to be at risk because of AI. And I would say software is in the market sights right now. We'll talk a bit about, capital expenditures, spending by businesses on AI. These are huge numbers. It was $400 billion last year spent on AI expenditures, probably more like $600 billion this year. So we'll definitely kind of talk about, what are the implications from that, huge amount of spending overall. I mentioned that this K-shaped economy. What does that mean? Well, it means, that upper 20% of U.S. households, account for about 40% of spending, whereas that lower 20% only accounts for about 10% of consumption overall. So, if you're looking at cracks in the economy, if you look at, auto loan delinquencies, credit card delinquencies have also picked up in recent months. We're watching that very closely. Mortgage rates are hovering a little over 6%. They have come down from more like 7% a year or so ago, but we definitely need to see more movement lower to really kind of see increased inventory to really reduce home prices overall, to bring more inventory online. Some interesting facts about mortgages: about 70% of borrowers have rates below 5%, and more than half are below 4%. So that kind of shows you the challenges. Folks are staying in their homes longer. They're not trading homes because they can't afford to trade up a 3 or 4% mortgage for a 6 or 7% mortgage. We talked about tax cuts and deregulation. We're going to see a big impact, especially in the first half of this year. We think it's going to be almost 1% of GDP, of economic growth, that's going to come from this fiscal stimulus. A lot of that's going to come from tax refunds. Again, the administration's focused on deregulation ahead of the midterm elections, especially if you're looking at recent polling has been a challenge for the administration. So we'd expect a lot more focus on affordability, on a housing plan, attempt to bring mortgage rates down, make conditions easier for borrowers overall. I would say also, expect some downward movement in energy prices this year. Again, the administration's doing whatever it can to try to lower energy prices this year as well. But because of that easing by the Federal Reserve, because of this fiscal stimulus that we're getting for individuals as well as businesses, we don't project any kind of sharp slowdown this year with respect to the economy. I would say those in my shoes have been saying a recession is inevitable for the last 2-3 years. It hasn't happened. What's happened is the economy's been very resilient. And again, we'll talk about the reasons why it's been resilient overall. We have seen some noise around tariffs. I'm sure you saw last week the Supreme Court struck down the Trump administration's tariffs. The administration quickly moved to put in place this 10% tariff across the board. The code, it's Section 122. The main takeaway is the administration can get somewhat close to where they were through other measures, but those might only last about 5 months or so before they're kind of knocked back down. So that was a bit of a headwind for economic growth, put some upward pressure on inflation. We'd expect that to be reduced to some extent in the coming year. On the Fed, I won't get too technical on the Fed. We always love talking about the Fed, but the Fed's trying to get the rates down to basically 3%. They're a bit above that right now. If you look at what the market's saying right now, the market's saying we think the Fed's going to cut 2 more times this year in 2026. But the Fed's very much divided right now from the committee's perspective. So again, the outlook's uncertain. It really depends a lot on the developments in inflation and the developments in the employment market as well. I think another factor is on immigration policy. The Fed's trying to balance immigration policy. They're trying to figure out what AI means for the workforce, for the labor market, what it means for inflation, what it means for industries. I think we're all asking ourselves, what's AI going to do to specific industries? What's it going to do, to the economy? I was here for the previous discussion. I have boys that are 11 and 13. I always think about, what are they going to do? Are they going to go to a traditional 4-year school? Are they going to go into trades? What jobs are going to be there? Those coding jobs that we told everyone to go into a few years ago may not be there 2 or 3 years from now. But again, a positive backdrop. We're seeing fiscal stimulus. We're seeing the Federal Reserve cut rates. That should be supportive of the economy, of markets overall. It isn't just the U.S. cutting rates. 9 out of 10 of the world's central banks are cutting interest rates as well. A big question here, which sectors are going to benefit most from capital expenditure? Well, what we've seen so far is it's been kind of what we call kind of the picks and shovels, kind of the chip companies, for example, that have really benefited a lot from the capital expenditure in AI. But to give you a sense of the amount of spending here, I mentioned some numbers earlier, but if you look at the top 5 U.S. tech companies, the value of those combined, the collective value is about $18 trillion. That exceeds the economies in total of Japan, India, the UK, France, and Italy. So that shows you, the U.S. has been so dominant in these areas for so long. We've created this, enormous sector in technology. It's kind of the envy of the rest of the world, but that kind of shows you the magnitude and scale of that tech company revolution. If you think about the amount of spending that's going on, what we call CapEx, I would say one risk right now is the Amazons of the world, Microsofts, et cetera, are spending so much additional money. Now the worry from markets is, are they spending too much money? What are they getting back for all that money that they're spending? And it's gotten to the point where in quarterly earnings, companies are punished for not spending enough on AI. So I mentioned $400 billion last year, more like $600 billion this year. I would say one concern for us is that these companies were, funding the spending from cash flow before, from their businesses, from their operating cash flow. Now they're increasingly turning to debt markets, to fixed income markets to raise money for their AI spending. So we're becoming, a bit more concerned about that overall. But to us, semiconductors remain, clearest winners. Companies like NVIDIA should continue to benefit. Energy's performed very well, especially here year to date in 2026. Utilities as well. They're seeing a massive, CapEx cycle to build, new generation and expand transmission lines. We talked about data centers, earlier here today. Natural gas is expected to provide nearly 40% of data center power this year. So we're looking at, smaller, mid-sized companies that are leveraged into that sector overall. But I'd say what we've seen year to date over the last couple of months is that the market's shifted from this rising tide lifts all ships, anything connected to AI does very well, to a lot more nuanced view, a lot more differentiation around what sectors are going to win, what sectors are going to lose. So we think that large firms with resources to invest in AI can reduce their reliance on labor, and they can also gain market share overall. The concerning part is if you look at the unemployment rate for those that are 16 to 25, for example, that unemployment rate's a lot higher than the overall employment rate. So we're becoming more concerned about that with a lost generation potentially there, that 16 to 25-year-old unemployment rate. I think we talked about that concern over companies, over investing in AI. We'll definitely, watch that as we move throughout the year. But a lot of these companies have been, more privately held versus publicly held, so we're not able to, get as much data and draw a lot of conclusions about the trajectory here. But I would say, one final point on this slide, I think that, there's a lot of uncertainty around what AI is going to mean for individual stocks, individual sectors, throughout the year. We always preach, diversification for all of our clients and their portfolios. We've had a lot of clients that have been overexposed, to U.S. large cap technology companies and their 401ks, for example. So I would encourage everyone to think now about, diversification, look at, international areas, look at smaller companies as well. It isn't just a U.S. large cap technology story. So moving on from the economic backdrop, we'll talk a little bit more about building the future of the U.S. economy. I'll mention some advantages that the Midwest has, that I think we're all in this room very, very excited about. But what we're showing here is productivity, how productive are workers in the U.S. versus other countries. Again, a tremendous advantage that the U.S. has. Part of this is technology, is AI, but that green line kind of dominates all these other countries as far as the productivity, the output per hour that our workers are generating. So we have a very dynamic economy. Again, the envy of the world as far as technology. All of us in this room, it's our challenge to kind of increase that advantage, especially for those of us here in the Chicago area. But as far as the U.S. natural resource advantage, the previous panel talked about that quite a bit. Hydrocarbons, water, and land. From an energy perspective, the U.S. has been the largest exporter of liquefied natural gas since 2013. So some big advantages there. On the downside, you've read about these rare earth reserves. That's definitely limited here in the U.S. China is very dominant in rare earth, things like batteries, for example, components to build batteries. We do have the advantage of having close allies like Australia, for example, that are very abundant in those rare earth reserves. But you'll continue to see these stories from the media talking about that U.S. being devoid of rare earths, China having an advantage there. Again, we rely on these allies like Australia to really kind of pick up the gap there. What other advantages does the U.S. have? Well, they spend almost $1 trillion on research and development. That's more than 2 times the next country, which is China, in R&D spending. So, a huge advantage there. Very strong human capital. Corporate management's very strong here in the U.S. High innovation, which we mentioned with respect to, the labor productivity. And again, a lot of that's driven by the IT sector. But that's one component, but productivity isn't just superior in the U.S. in IT. We're also talking about agriculture, service, manufacturing, construction, really all across the board. The U.S. has that productivity advantage. We're talking about the Midwest in particular. What advantages do we have in the Midwest? Well, we have the Chicago Bears. We're not sure if they're going to be in Indiana or Illinois, but we definitely have the Chicago Bears. But if you think about talent, education, you think about the quality of education, the universities that we have in this area, very exceptional research-driven universities. They really produce deep pipelines of graduates, areas like engineering, healthcare, and data science. So you have that skilled, job-ready workforce here and ready to go. We talked about unemployment earlier. The unemployment rate in the Midwest is significantly lower than that as a nation overall. So something that we should definitely be proud of in the Midwest, having that lower unemployment rate. I would say, one factor favoring the Midwest has been that, fundamentals are shifting in the Midwest's favor. If you look at, rising costs in coastal markets like San Francisco and New York, when companies are making decisions, the Midwest is attractive from, that perspective. Competitive utility costs, that available workforce that I talked about earlier, and proximity to both customers and suppliers as well. We have a lot of infrastructure, rails, airports, et cetera, in the Midwest. A big structural advantage here where we sit today in the Chicago area. Also we've been rewarded by federal programs like the CHIPS Act, the Inflation Reduction Act, bipartisan infrastructure law. They represent, a large industrial policy with, investment disproportionately done here in the Midwest. So very, very excited about that. I think we talked about, technical colleges, apprenticeship programs. The Midwest is really a leader in those, types of areas, but it does require, an active partnership between, universities that was talked about in the last panel, universities and businesses, employers, and educators to really, translate that potential into the overall workforce pipeline. Energy capacity is, going to be a really big deal here. Data centers, EV battery plants, semiconductor fabs, advanced manufacturing, very energy intensive. We have that power capacity here available, grid reliability, clean energy as well. It isn't an either or. We need all the sources of energy here to really power that overall demand. But we do have a lot of built-out infrastructure, fresh water, et cetera, that really should be a key advantage for the Midwest. We are seeing, I would say, at the margin, a lot of venture capital talent coming to the Midwest, coming from the coastal areas to a lower cost of living in the Midwest. So we're seeing more opportunity here for entrepreneurs, for venture capital, et cetera. And if you look at regional collaboration, the Midwest has a lot of regional collaboration, very competitive alignment between the workforce, marketing, infrastructure, incentive strategies across areas. So a lot of areas have a lot of fragmentation. The Midwest has a lot of that regional collaboration. We think that affordability in the Midwest, it isn't great right now in the Chicago area, I will say, but if you look at the Midwest overall as a whole versus kind of the coastal areas versus New York, San Francisco, for workers, for companies looking to establish roots, it is a much more affordable area than the coastal areas overall. So we're relying on partnerships in particular between education, businesses, really to drive forward the Midwest as an innovator. We'll talk a little bit about the U.S. capital markets advantage as well. This slide shows private capital valuation. What is private capital valuation? Private markets are just markets that are not public. So there's a public stock market. There's also there's equity. There's stock in private markets, but it's not publicly traded. So areas like private equity, you might have heard about private credit, private real estate, private infrastructure as well. It's a huge, huge market. It's $14 trillion total, and the U.S. really dominates that private market as it does the public markets as well. So the U.S. commands over 60% of global private capital. That really means the next generation of things like factories, innovation hubs, and infrastructure as well, overwhelmingly concentrated here at home. A huge gap between the U.S. and every other region. Almost 3 times an advantage over Europe, Asia at 9%, the rest of the world at 7%. So the U.S. is really in a category of its own with respect to public markets and with respect to private markets as well. So we think that for economic developers, this should be really a prospecting tool. The capital exists in abundance very close to home for us. So the conversation with private equity, infrastructure, venture cap shouldn't be can you invest here? It's why wouldn't you invest here? And I would say the Midwest has been really under-leveraged relative to its share of U.S. assets. A lot of investment, as we talked about earlier, has gone to those coastal markets, has flowed to those coastal markets. So our challenge here is to really change that trajectory, telling a compelling story about why companies should set up roots here, the advantages that we have from an energy perspective, from a worker perspective, education perspective, cost of living, et cetera. So we think a lot of opportunity here in the Midwest. We talked about the dominance of the technology sector as well. There's a lot of chatter last year saying without technology investment, we'd be in a recession here in the U.S. That's really not true. Technology investment is very significant. It's about a quarter of economic growth, but it's definitely not all is coming from technology. But that tech contribution's been remarkably consistent. If you look at that green bar there, if you look at the first quarter of 2023 for the third quarter of 2025, tech investment demand really maintained a steady positive contribution to that resilient GDP growth that we talked about earlier. And as even overall GDP growth fluctuated a bit, that technology investment has become very critical and very, very, very stable. I'd say also GDP growth has moderated. We've seen growth moderate more in that kind of 2% level from more like a 3% type of pace. So I think that this technology investment becomes even more impactful if it can be consistent, if it can contribute toward that overall GDP. So if we see slower growth, we need technology to really do its share even more than when the pie is growing much more quickly. I will say, one warning signal for us is that tech net exports turn negative. That's that light blue segment that drips below zero in Q1 of 2025. That reflects a growing import dependency for technology goods. And for the Midwest, that's an argument for domestic production, semiconductor, hardware, and advanced electronics production to happen right here instead of importing it. I will say the rebound in Q3 has definitely been encouraging. We've seen that net tech contribution, those yellow diamonds in the chart here, that's showing a recovery from Q2 and Q3 of 2025. So that combined with stabilizing GDP growth suggests renewed momentum in that technology investment. So we think that communities that have been building tech infrastructure, talent pipelines, and site readiness should be positioned well to capture that next wave. But again, too often the Midwest is perceived as not being a big player in technology, that it's coastal data centers, West Coast campuses, Sun Belt chip factories, for example. But we do have the input and technology that this all demands here in the Midwest: power, land, water, workforce, and logistics that can really be strengths for us overall, in addition to the manufacturing industry. We'll talk a little bit about how we're using AI overall in our business. So I work in wealth management. We help clients to invest on a daily basis. We help companies invest their 401ks as well. But really, I would say AI has become a powerful tool across industries, and that's not least of which is wealth management in general. But I will say it hasn't taken the place of our wealth advisors by any means. We still think that our clients want to talk to an individual, talk about issues they have, cash flow considerations, goals, objectives, their time horizon, et cetera. So, one area we're looking at is, personalized portfolios. It becomes, much easier with the advent of AI to build, truly tailored custom portfolios for clients. There are a lot of wealth managers who say, we have 5 model portfolios from conservative to aggressive. You need to choose one. At Calamos, we're very much tailored to our individual clients. I would say AI helps that even more to align, portfolio recommendations, align financial planning based on client goals and their risk tolerance as well. You could see a world where you have, AI chatbots, virtual assistant for kind of routine client inquiries. Also, automating things like client onboarding, document collection, making the experience much more seamless for clients overall with the benefit of AI. If we look at areas like portfolio management and research, an important part of our business, our portfolio managers and analysts can screen large amounts of data, large universes of securities, a lot faster than traditional methods. They can use natural language processing, analyze quarterly earnings calls from companies, analyze regulatory SEC filings, analyze the news as well, and really create predictive analytics for forecasting market trends or risk signals as well. One other important implication with respect to taxes: people don't like paying taxes. We want to minimize taxes wherever possible. So it can help us really optimize tax loss harvesting. If you have a loss in a portfolio, you sell that loss, reinvest it, and you kind of bank that loss going forward against gains in your portfolio. Compliance, risk management is a big part of our business. This can really flag suspicious trading patterns, suitability issues. That's applicable to big banks, also wealth managers as well. can streamline regulatory reporting also. And I would say contract document reviews. Those are definitely areas that are at risk, because of AI. Any kind of document review, back office, operations, compliance are definitely areas where we think, AI is going to change things quite a bit. Also, billing, reconciliation, performance reporting, we should see AI making a big difference there. Also just cutting down on errors overall. It should be a nice sense check for us, across our portfolio management capability. Also, I'm sure you're already using these tools quite a bit in this room, but things like meeting summarization, note-taking, that's been very helpful for us. In our business, you want to focus on your client when you're meeting with your client. You don't want to be, typing away notes or writing down notes. You can use these tools to, take notes. They can send you, automated follow-ups, follow up with your clients over email, post those meetings as well. From a marketing perspective, we're already using AI quite a bit to send out personalized data to our individual clients. So we're able to push something out to hundreds of clients, but it feels personalized coming from your wealth advisor directly. Can personalize content directly for you. There are other firms where your advisor kind of appears like a chat bot, and you're actually able to ask that advisor questions, and it actually gives pretty good answers there. So again, I'd say it's not going to take the place of our business, we don't think. We think there'll always be a place for an individual, but again, it's helping us become much more efficient with respect to what we're doing on a day-to-day basis. I would say one important consideration for us is from we're fiduciaries, we're required to put clients' interests first. So we're a little bit reluctant to use AI tools as a general rule because of those fiduciary concerns. So, data privacy is a big constraint. We want to protect our clients' data. We want to adhere to any, regulatory considerations as well. But this is really helping, scale our business. I'm sure scaling a lot of your businesses in this room as well. Efficiency, scale, but again, not replacing humans, but really making humans more productive in what they're doing on a day-to-day basis. So with that, I thank you for your attention and happy to take any questions you might have today.
Hi, I had a question you mentioned that GDP was strong the second half of 2025. Was that a nominal number or was that effective purchasing power? Because I know the dollar devalued across many countries. So are people just paying more for goods or was it actually goods sold that caused the GDP to go up?
Sure. That's a great question. Question was on nominal versus real GDP. Where was the actual growth coming from in the second half of the year? I would say, both were positive. I think the administration's talking about 5 or 6% nominal growth, before adjusted for inflation. Growth was at about 5% before inflation. If you remove inflation, what we call real GDP, that 5% minus that 2.7% was more like, 2.3%. But you're absolutely right. The dollar weakened quite a bit, about 15% last year. That made, imports, a lot more expensive, had a significant impact on our, trade deficit, for example. It also had a lot of impacts on, international stocks versus U.S. stocks. So if you were invested in European stocks, for example, last year, when you moved those back to the U.S., you had a nice gain, about a 15% gain, because the currency appreciated versus the U.S. dollar. That's kind of the inverse of what's happened over the last, 10 to 20 years. The U.S. dollar's been very, very strong. I would say one difference is, this administration's been kind of fine with the dollar depreciating overall in an effort to really make us more competitive from an export perspective. So they're really trying to rebalance that export-import consideration.
What effect do you feel that crypto is going to have on the dollar, on the dollar, period? Sure.
Yeah, the question was, what impact's crypto going to have on the dollar? Actually, it just came from we had an event in the city today on what we call the digital asset ecosystem. So, related, not directly investing in crypto, Bitcoin, but more, the exchanges, the infrastructure around crypto in general. So I would say, Calamos is in this space. Calamos has some exchange-traded funds that are in crypto that kind of protect on the downside, but also preserve some upside in crypto. But I think it has had an impact on not just the dollar, but currencies in general. You're seeing, it's also impacted gold. Gold's had an incredible run here over the last year. there's some evidence that, both individuals as well as central banks, institutions are diversifying a lot of their holdings away from the dollar into, crypto, digital assets, into areas like gold because of fears around, U.S. policy, inflation, debt, et cetera. So it's definitely had an impact. I think all central banks and all governments are looking at what's the impact going to be of not just crypto, but gold, other stores of value. The U.S. has kind of dominated reserve currencies of central banks for the last 100+ years. But I would say at the margin that definitely could impact the dollar over time. People are using crypto for transactions, using alternatives to the U.S. dollar.
I have deep concerns about the concerned stability of the U.S. economy with the reliance you mentioned on the exporting of natural gas, and I would add petroleum and coal. The climate crisis is worsening definitely, and this is taking us to the brink if we continue this reliance. But how do we maintain the stability of the U.S. economy as we hopefully phase out these fossil fuels which threatens to disrupt civilization to its core?
Sure. I think it's definitely an important point. I made the point earlier that I don't think it's an either or from an energy perspective. I think we need a lot of different sources of energy. Obviously, we've seen from the U.S. administration's perspective a kind of a sea change in policy over the last couple of years versus the previous policy. We heard a lot about sustainability, a couple of years ago as far as, solar, wind power, et cetera. Tax credits for electric vehicles, for example, a lot of those policies have been rolled back. So I think that the pendulum maybe shifted pretty far a certain way, kind of came back, maybe shifted too far another way as well. But I think we need all sources of energy right now in the U.S. But we definitely share some of those concerns with respect to climate considerations. But again, this administration's rolled back a lot of those policies, a lot of those tax credits, et cetera. So I would expect more of a movement toward sustainable energy over the next 5 to 10 years, but we have kind of taken a bit of a step back here.
Hi, my name is Nitin. I'm the founder of Neighbor Hub, focusing on creating opportunities for youth. You mentioned something about a concern, an uptick in the unemployment rate for 16 to 25 age group. Yes. Was there a further research done as to why that's happening, or if it's in specific areas or specific regions?
Sure. Yeah, great question. Yeah, I would say, I think the unemployment rate for those that are 16 to 25 years old is about 7% versus the overall unemployment rate, that's about 4.3%, so significantly higher. I think a lot of that is simply a lot of entry-level jobs have been put on pause. We have seen a bit of a slowdown in economic activity. I think there are a lot of industries that are, questioning whether entry-level junior roles can be done by AI. I think there are a lot of industries that are saying, your first 2 years, you were kind of training on the job. Maybe we don't need those certain roles. Maybe if it's, a Big Four consulting company or a law firm, the associates the first couple of years, maybe AI can do a lot of that work that they're doing overall. So I think that's definitely part of it. I think the other part is this kind of skills employment mismatch that we were kind of talking about on the previous panel. As well, what should we be encouraging young people to study right now? I think there's a lot of uncertainty around what the job market's going to look like, 5 to 10 years from now.
Hi, my name is Jeremy. You mentioned the dollar depreciating 15% over a year. Where do you recommend retail investors or consumers to put money that's not all the way parked in risk assets like the stock market, but isn't losing all this value in a savings account? Sure.
Great question. Yeah, it sounds really boring. We talk about diversification quite a bit. We've had a lot of clients come to us and say, hey, I did very well in U.S. tech stocks. I have a concentrated position in NVIDIA, but I'm kind of worried about it going forward. Can you help me diversify that position, for example? We've had a very nice run in stocks the last few years. A lot of folks are concerned about, valuations, concentration. I would say, boring fixed income bonds did very well last year. Bonds were up about 7%. Last year. So, high yield savings accounts were paying 5+%. Now they're paying more like 3%. So I think it's a great time to kind of think about, a broadly diversified portfolio, a balanced portfolio that contains something like 60% stocks, 40% bonds, has done very well over time. kind of offered between 7, 8, 9% return over a very long period of time. So, I'd encourage you to look at, some fixed income investments. Maybe you don't want to take too much risk, like smaller stocks, for example, or emerging market stocks, but there's a lot of value to having that kind of broadly diversified allocation.
Free Chief Investment Officer asks you questions. Henry Hodge with Illinois EDC. Something we're doing more now, or I'm doing, is doing some company evaluations, looking for, good companies that want to do good investments, if they want to be in Illinois. If you had 5 minutes to read an earnings report, what are you going to look for?
Wow, yeah, that's a great question. If I had 5 minutes to read an earnings report, what am I looking for? We'd probably use AI to glean that earnings report and figure out the exact factors. So we have a team of stock pickers, equity analysts. That's not what I'm doing on a day-to-day basis. We kind of outsource that to both internal folks and external folks who follow stocks on a day-by-day basis. I would say quality growth is kind of a buzz term right now. You want companies that are growing, but in a high quality way, generating significant cash flows. So we typically look at how are their revenues, how are their sales, what's their profit margin. Profit margins have been surprising to the upside too. Our companies here in the U.S. are much more profitable than their counterparts in Europe and in Asia, for example, something we should all be very, very proud of. But yeah, we're looking at sales, we're looking at year over year sales growth, we're looking at how much cash are they throwing off, how much cash are they earning, are they in the right markets, what are the risks, do they have a moat, kind of a competitive edge around what they're doing. I'd say more recently, is it susceptible to AI disruption? We've seen various sectors go through these waves. I expect that to continue. We had an investment committee meeting yesterday. It was a big topic of discussion, kind of expect these waves from one business sector to another, that AI could take over the software and there could be something else tomorrow. I think there's more of a demand for kind of hard assets, things that can't be replaced by technology.
Thanks, John. Always like a JON, by the way. Thank you very much. Nice to see another one of those. One more round of applause for John Adams there. Appreciate that, Calamos. A lot of great questions all day long, and really thank you all so much for having me here, for being a great audience. Lots of great questions. The panels, I think, all left us with something to think about. The keynote speakers, just from the beginning to the end, whether it's Joe's inspiring story through quantum, investments, all this sort of stuff. A lot of heady conversations here today. Appreciate you having me. Just a shameless plug. A lot of these same conversations we have on WGN all day, we have them on my show Monday through Thursdays at 6 p.m. So if you're driving around, making dinner, 720 WGN's, I'll be on tonight. I'll talk a little bit about what we did here today at 6, but I really appreciate y'all having me. You've been a great audience, and I can't wait for the third annual one. Hope I'm invited back and to learn a lot. So thank you all. I really appreciate it. And here's Joe Cassidy. Sorry.
Thank you, sir. One more time for this gentleman. Local talent, did an amazing job. Thank you, John. And thank you to all of our partners at WGN Radio today and over the years, and connecting our community and telling great stories, so we're very thankful. Thank you to COD's facilities, the AV team, multimedia, marketing, continuing ed, innovation DuPage. All of them just put their hearts and souls into this event today. Special thank you to the Julies, Julie Ryan and Julie Konzik. You bring order to the universe. Thank you. Thank you to our experts, our panelists, our sponsors, and for continuing to invest in colleges and universities. This dialogue, our research, our training, our education is necessary for this country to continue to innovate and thrive. I'm so glad that Miho and Trustee Howard discussed the emerging clean energy market. It turns out AI, quantum, big data, everything has big energy demands. I'm happy to report that the college is leading 2 Illinois clean energy grants to make sure we have both skilled labor and the energy firms necessary to power it all. Shout out to my colleagues from Joliet Junior College. Their CJ Hub team is in the room. Thank you. So as we bring this day to a close, I want to leave you with this. What happens after today is truly what matters most. Keep the conversations going. Follow up on the connections you made. Connect with the College of DuPage, Innovation DuPage, and all of our partners to leverage this network in support of your business. Entrepreneurship can be a lonely path. Don't do it alone. We're invested in your success. To our educators and policymakers in the room, the entrepreneurial mindset is not a passing phase. It is akin to literacy, numeracy as a foundational skill set to help our students keep pace and lead in this rapidly changing world. With that, let's officially bring this year's summit to a close. There are refreshments in the hallway, beverages in the back. Thank all of you for taking the time to be in here and making this community so special. Thank you all. Be safe.